If you look at the ETFs that track the both high-grade corporate debt and high-yield sectors, the LQD and the HYG, pretty dramatic downtrends. Now, most of that move down this year is just Treasury yields going up, so Treasury bond prices down. But that last little bit in the last several weeks, that is corporate debt way underperforming government debt, which obviously means spread widening, people getting a little more concerned about the risks there. I think it's probably important to contextualize it a little bit because people are afraid that there's a chance that GE debt, which already trades as if it's been downgraded to junk, is going to essentially swamp demand in the high yield market. And that HYG and other index junk funds would have to kind of swallow it, sell other stuff. Corporate debt to GDP is at high levels. It's back to peaks that we saw in 2007 and 2000. That has people a little bit concerned. But the coverage of that debt, the expense that the companies have to undertake because yields are still relatively low, really not that big a deal. So spreads are up from the very, very low levels. But if you look at it back 15 years, they're really not showing any alarm. It's much more of an indigestion problem for the corporate bond market than it is a contagion issue, at least for now.
So when folks say corporate debt is larger now than in '07, and that the rollover over the next 2 or 3 years is substantial, over half triple B, I mean, are those things
2 or 3 years, absolutely. The amount that's triple B is a little bit more of a concern, but in the next year, it's a tiny percentage of any debt that's coming due. So it's kind of like, what's the moment of truth here? When is it going to come to a reckoning? And I don't think that that's really right immediate. People are panicking. And also, talk is GE will do almost anything, asset sale-wise, whatever, if they can, to try and forestall any downgrade.
I can remember the talk about these kinds of cliffs back right after the crisis.
That's right.
Everybody's so concerned about their ability to refinance and roll and or extend, and then it happened.
The market remained willing to float them, yes. And I mean, obviously there could be a moment when it doesn't happen. But outside of recession, it's hard to see quite when you get that big drop in corporate cash flows that brings it, but it becomes choppier. The stock market's already saying we don't want companies with a lot of leverage. So they're gearing up for it.